Welcome to Financial Focus, brought to you by Gulf Coast Financial Services founder and CEO, John Kuykendall. John and his team of financial, legal, and tax professionals have been providing North Florida savers and investors sound, comprehensive financial guidance for over 30 years, helping you to achieve important life and planning goals. Be sure to like, subscribe, share, and tune in for more Financial Focus by visiting gulfcoastfinancial.net.
And welcome into the program. This is Financial Focus, brought to you by the best of the best in financial services, as named by the readers of the Lake City Reporter, 7 years and running the team from Gulf Coast Financial Services. This year, celebrating 30 years in the business as an independent advisory firm, founder and CEO John Kuykendall with us, as always, providing that financial focus, helping us to better understand our money and the decisions that we make with it, making sure each and every dollar is working its hardest to help us achieve those important financial goals. And John, no easy task in this market. We know that the market's moving up, down, sideways all the time, but lately it seems to be a whole lot more down than up.
Well, Peter, that's right. There's a lot of pressure, a lot of different outside functions that are causing this. And, the main one is inflation. I mean, our inflation is running crazy. Gas prices are going up. I understand diesel's like $6.50 a gallon in California. And so it's going to drive everything up. Cost of goods are going to be more because it costs more to get the goods delivered now. So it's just a rippling effect, and the market's feeling that. But, Peter, this is no different than other times we've had in the past. We had the hyperinflation in the 80s. Prime was 20%. So, we've been through ups and downs. The market goes up and down, and it will always come back up. We have a good economy. It's strong. It's just that we have the war, inflation, all these other things that are driving us crazy. And so hopefully this thing will settle down pretty soon. We knew that 2022 was going to be shaky, more shaky than 2021, but we thought we were going to have a smoother ride. It's been rocky.
Yeah, in fact, April for at least one specific market indice, the NASDAQ, the worst month since 2008. No one loves hearing that. May continued with the rocky road, more losses in May. John, we know that there are some challenges, there are headwinds. In hindsight, retrospect, on another note, positive, jobs market seems healthy. It's definitely an employee's job market. You can, if you want to, seems like you can go out and find a reasonable job. Corporate profits seem positive. They're coming in, being announced healthy. So there are some bright spots here, but we know that more losses in the market is no one's favorite thing to see. And the Fed really kind of trying to rein in this liquidity that they've created over the past really 14 years since the Great Recession. Yeah, they've been doing quantitative easing, and now with COVID, they've got more than $9 trillion on the balance sheet, and money has been cheap and easy to access, and now it seems they're moving a different direction, and the market hates change, especially large changes.
Well, when we see interest rates go up, of course, that drives bond prices down. And so our bonds are not a safe haven right now, as is the stock market. It's the first time since 2009 that we've really seen the market react this way. The Fed raises rates in order to control employment. One of the Fed's main jobs is to seek full employment. The problem here is we have what I consider to be full employment. If you want a job, you can find a job. But the problem is we've got all this inflation because of all this money the Fed's put in. And right now, we've also got, Peter, which isn't talked about a lot, we've got a lot of money that is on margin, where people have actually borrowed money to buy stocks, but through the Robinhood and the meme stocks and all that. And so as these interest rates go up and the market comes down, we're forcing more and more of those people to sell their stocks because they can't meet their margin. So it's creating a rippling effect in the market. Eventually, all this will play out and we will see somewhat sanity, I think, before the end of the year. But right now it's crazy. Hopefully, if your advisor's doing his job, you can look, you shouldn't, while the NASDAQ's down 24% now, your portfolio shouldn't be that far down if somebody's watching it. So don't panic. Just give them a call, get them to explain to you how they're managing it. And I think you're going to be happy. This isn't a time to overreact.
Well, John, the old saying is that you have not lost money until you sell when the market's down, right? However, I have to wonder, is the same true on the other side? There were a lot of people who had some euphoria that their home value had increased so much and was so high. But as that seems to be turning around, did they really make money unless they sold? And the same thing kind of in our portfolio value, or if you go to cash in chips in Vegas, you could have been way up at the table. But if you end the day way down, did you really make money at all, John?
Well, that's the thing, Peter. And, it's fine to say that I haven't lost until I sell, unless I'm retired and I'm living on my account.
And you have to
then
sell.
I have to sell in order to get the money out to live. And that's one of the reasons that we always talk about having the bucket approach, where we've got more than one bucket. We don't want all of our money in the growth bucket in the market. We need to have a liquidity bucket so that for the next 12 months, 6 months, we know that we can live without having to take money out of our growth bucket. And a lot of people, because the market's been so good and we have so many new advisors, they don't have a growth bucket. They don't have a liquidity bucket. They've got a growth bucket. Everything they have is in the market. And now they will be losing money because some of them are going to have to sell in order to live.
Well, and in fact, John, that's what we're going to be talking about today. There are essentially 3 different directions that the market can move over time. It can go up, it can go sideways, or it can go down. There's also 3 different directions, if you will, of our specific dollars. We can be contributing to accounts, we can be holding, or we can be distributing. We can be adding new money, we can be letting it ride, or we can be creating income. In the scenario of what we are doing with dollars and then what direction the market takes, there are some very, very different results. And that's where I think this bucket strategy that you talk about and the income allocation process really help to kind of simplify the strategy, the approach to these different potential combinations of scenarios.
Well, that's right, Peter. The market is going to go up and down. We're not going to have good years every year. And so as you talked about, we've got where we're making contributions to our 401k, or we're taking money and putting it aside while we're working. And then we've got the people who get scared and don't make any contributions for a long period of time. And then you got the people who are retired who are having to live off of that bucket. And I think it's interesting that if we took from 2000 to 2021, the actual returns in the market, and we were putting in $10,000 every year at the end of that time period, because we started with the $10,000 and we've added to it, we end up with $643,000. That's a lot of money, and it shows the potential that I have by growing that portfolio.
Yeah, you've actually sent along, and I've been looking and studying this chart. It's very interesting, John. You've got the different market directions actually detailed by real world S&P index returns from the year 2000 all the way through the end of the year 2021. And then we've got 3 different columns, one for contributions, one for holding money, basically already invested dollars, and then another for distributions. For the first 3 years, going from 2000 through 2002, the market was down. And if we had $100,000 to start that period of time and we're just holding, not making new contributions, we would have less than $60,000 at the end of those 3 years. Whereas if we were adding $10,000 a year, we have less than that $30,000 over the 3-year period, but the losses aren't nearly as substantial.
No, they're not, Peter. I mean, we're sitting with a little over $20,000, even though we had returns of -10, -13, -23, which, by now most people would have pulled their hair out and left the market. But
behavioral finance.
Yeah. But if you look at it, I mean, we're at $20,000. So I've lost 10,000 of my contribution. But if I continue to contribute 10,000 every year, I'm going to have that 643,000 at the end of time, at the end of 2021. That's an awful lot of difference and an awful lot of money just by staying in the market, staying focused and watching it. And that's one of the reasons why we can't let our old 401ks or our old retirement accounts just sit there and languish and not manage them and do something with them. We have to get some return off of them.
Yeah, we really do need to pay more attention to them. And the beauty of the 401k, out of sight, out of mind, it happens automatically. They put automatic features inside of that automatic savings with those life cycle or target date funds. And a lot of people feel like it's completely set it and forget it. We really need to be paying attention. Another thing that struck me, John, here over a slightly longer time period from 2000 through the end of 2010. So this is a sideways market. That's what's been called the lost decade. If we started that period with $100,000 and didn't add anything, versus if we contributed $10,000 a year, starting from scratch, starting from zero, we actually have significantly more money having started from zero during that lost decade, but not making the contributions. And it ends up being that we end up with $117,000 over that decade if we were simply adding $10,000 a year starting from scratch. And if we had started with a full 100,000, we would have only had $85,000 by the end of that 11 years. And I know numbers are confusing on the radio, and you can make this chart available. We'll probably put it in the show notes somewhere.
Well, sure. We'd be glad to give it to anybody that wants it. But I think it's interesting, Peter, that I actually lost $15,000 of my $100,000 during that 10-year period. But by dollar cost averaging into the market in good times, bad times, I ended up making $17,000 versus having $85,000. Now, the other thing, which is not good for retirees, if I was taking out if I had 100,000 and I was taking out the 4% rule.
So now we're on that final column. We're actually
final column. We're on the distribution stage.
We're taking income.
I got to get the money out, and the majority of my clients are. You know, we had that old 4% rule, which said I can take 4% out of my portfolio and never lose anything. I'll still have money. Well, if we took out 4,000, took out 4,000 a year during that time period from 2000 to 2010, I would only have $38,000 left.
Ooh, how confident do we feel about moving into the next decade?
Yeah. I mean, there is no way that I'm going to feel comfortable. I'm going to have to cut out all of my spending. And, you know, with inflation, taxes, and all the stuff we've been talking about on the radio show going up, we're going to need to, that's just not going to work. We've got to come up with another plan. And that's the reason we need income allocation. We need the income plan, and we need the bucket approach to make sure that our assets are working for us and that we don't have to take out money in a down market. But, you know, a lot of retirees, they've seen that because in that period of time, 2000 to 2010, they saw their portfolios get split in half in many cases, or 3/4, and they are still trying to make that up over the next 10 years, and they're having a hard time.
Well, and detailed in your chart, again, real world scenarios, folks might be thinking to themselves, well, yeah, that was a bad decade, but the next decade was fantastic. But the account, John, was so far down, and the need for income doesn't just stop. The next decade, even though it was up 172% in the markets, the account balance taking that 4% distribution actually continues to fall over the next decade.
Well, that's right, Peter. Even though we made that 172%, because I only had 38,000 to work with in 2010, I've only ended up with a positive 35,000 at the end of 2021. But I'm still drawing out the same 4,000 that I was in 2000, and you can't tell me that those dollars are going as far as they did in 2000.
No, certainly not. Well, ladies and gentlemen, if you'd like to see this chart about how money behaves, if you are making contributions, if you are simply holding an amount, or if you're taking distributions, depending on market direction, up, down, or sideways, definitely check the show notes below or give a call to Gulf Coast Financial Services. They can make sure that you get a copy. 386-755-9018, 386-755-9018. So here's really the critical key to all of this, John, is that if we've got that existing life savings, an amount that we've built up inside of our 401k, there are a few critical key milestones where we can begin to make different decisions with how our money is going to behave. And 59.5, you've got the opportunity for most workers, for those that are even continuing to plan to continue to work for several more years. You can actually take control so that your money doesn't have to ride this roller coaster, yet you can still continue to take advantage of this first column where we're making ongoing contributions.
That's right, Peter. And that's really because we're dollar cost averaging into the market. It really works. And also most of the employers are giving us free money. So we need to get that money, that free money, because it is free. And so 401ks, but the problem is a lot of people think that I've got that old 401k, I've got that old IRA account, it's sitting out there, I'm not touching it. If I don't look at it, I'm making money in their mind. And we really need to consolidate and also make sure that we're in the proper investments, in the proper risk tolerance for our situation. But the thing about this, key about this whole thing is that if you're getting ready for retirement or you're near retirement or you're going to plan on retiring someday, you cannot just put your money into your growth bucket and say, the stock market's going to keep me alive forever and I'm never going to run out of money. Because as you saw, 172% in 10 years, and I still couldn't make it up. That's a lot of great gain. And then that was a great 10 years.
Yeah.
We may never see that again.
The IRA rollovers that you talked about, in-service distributions, opportunities for us to better determine how our money is going to behave. And taking a look at this chart, it's plain to see the bottom line here. Making those contributions benefited significantly. The balance at the end of this time, $643,000. Whereas if we were just buying and holding, or actually simply holding money, $292,000. If we were taking distributions, we're only left with $35,000. Big time differences with what the results are with our money based on the direction that we are taking with it and the direction that the market is going.
Well, that's right, Peter. And it's certainly something that opened my eyes. I mean, it's really easy to see this chart and see the three ways that the market goes: down, sideways, and up, and also the way that we take money out. So it should be eye-opening to anybody that wants to see it. It's a great chart.
Now, John, you've talked about sequence of returns risk, and that's an interesting phenomena as well. Does the order in which the market moves actually matter and make an impact in the end results here?
Well, that's true, Peter. And sequence of return is something that we've been working with now for about 5 or 6 years. And what it says is that the sequence of returns, the amount of money that I make in the market, and when I'm pulling my money out, will have a strong influence on how long my money lasts. And so if I'm taking money out in a down market, I'm going to spend my money faster because I'm not going to be able to make it up quick enough. And we can see this in this 100,000 taking the 4,000 out. We start out with 100, and in 3 down markets, I've already lost half of my money. Although I've only taken out 12,000, the market's taken out the difference. If we turned that around and we started with a stronger return in the beginning, a positive return, then I would have more money and my money would last longer. So it's certainly something that retirees and most people haven't really thought about. And that's the reason that I stress the bucket, because when the market's down, I don't need to be taking money out of the stock market. I need to be taking money out of my liquidity fund. I need to have different buckets. And that's the reason we've always said that we need to have a predictable, sustainable income coming in to cover my basic needs so that my wants, I don't have to take money out of my growth bucket for my wants.
Designating and differentiating different dollars to have time optimized efficiency, otherwise known as the bucket strategy or an income plan. Knowing when you're going to use dollars or keeping some dry for a rainy day. And that's the thought process behind having that income allocation plan, a plan in writing specifically designed to show you how to generate income in up, down, or sideways markets. And in retirement, that's going to add a lot of confidence. Pick up the phone, give John Kuykendall and the team from Gulf Coast Financial Services a call, 386-755-9018, 386-755-9018. John, you talked a lot more about the importance of that written retirement income plan in your book, Financial Focus, as well.
Yes, we did, Peter. We talked a lot about that. The income planning is something that I'm really strong on. It's something I feel like that will give us the ability to have a better retirement, a longer retirement, and not have to worry about money. The last thing that a retiree, the two things that a retiree doesn't want to do is they don't want to have to call their kids for money, and they don't want to have to go live with their kids. And so the income plan will give us the ability to work up a budget and then project how long that's going to work, and then tweak it so that we can make the plan last longer. So it doesn't make any difference how much money. Some people need $1 million. Some people need $200,000. Some people only need $50,000. It just depends on how much income you already have coming in. A lot of my retirees who have pensions, which is a rare thing anymore, they actually make money during retirement and give me extra cash for me to invest for them. But most people now aren't going to have that luxury. And so we have to come up with that income plan so that we can replace that pension that we're all losing.
Well, again, if you would like help, assistance, designing, implementing, mapping out that optimized retirement income plan, pick up the phone, give Gulf Coast Financial Services a call, 386-755-9018, 386-755-9018. Visit online, gulfcoastfinancial.net, gulfcoastfinancial.net, and we will try to make the link to the chart that we referenced in today's program available in the description, but you can also call the office to get that. Great to go over as you are listening to the program, see the details, or on your own time. It really is eye-opening, so pick up the phone, give a call, request that chart, request the income planning opportunity to map out your retirement to optimize your income. 386-755-9018. John Kuykendall, founder, CEO of Gulf Coast Financial Services, author of the book Financial Focus. We always appreciate your guidance and insight.
Thank you, Peter. It was great to be here. Have a good week, okay?
Be sure to like, subscribe, share, and tune in for more Financial Focus by visiting gulfcoastfinancial.net. The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes. John Kuykendall is registered with and securities are offered through Kovac Securities, Inc., member FINRA SIPC, found online at www.kovacsecurities.com. Advisory services are offered through Gulf Coast Financial Services, Inc., a registered investment advisor in Florida. Gulf Coast Financial Services, Inc. is not affiliated with with Kovac Securities Inc. or Kovac Advisors Inc. Past performance is not indicative of future results. All investing involves risk. Investment decisions should be based on your own goals, time horizon, and tolerance for risk. Due to various factors including changing market conditions and/or applicable laws, the content may no longer be reflective of current opinions or positions.